Okay, so hello everyone. Welcome to this macro overview. Just for the record, I'm recording this on Sunday evening, so Sunday, June the 2nd, about 7 p.m., 2024, of course. Okay, so quite an interesting week coming up. We have a couple of central bank decisions. We have the Bank of Canada on Wednesday about 9:45, which is going to be interesting. And then, of course, we have the expected cut from the ECB coming up on Thursday. So that could set the tone a little bit for just how the market trades. We also have quite a lot of data, especially jobs data, employment data. We have the JOLTS on Tuesday. We have the ADP on Wednesday, initial jobless claims, as always, on Thursday. And then, of course, the big one is the non-farm payrolls, but also Canadian employment coming up on Friday. And mixed in with that, we have the two ISMs. We have ISMs from not only from the US, we have the services and we have the manufacturing on Monday, and then we have the services on Wednesday. But we also have some Chinese Caixin PMIs. So the point is that quite a lot of data coming out just to give us a sense of how the US economy is going, specifically the employment situation. And then we'll get some of the biggest central banks starting to sort of move, perhaps. Certainly that's expected with the ECB. We'll talk about that later in the week. And Canada is maybe a bit of a coin toss at the moment. So that's kind of interesting. So plenty going on. And of course, the other thing is that we've got the Fed meeting, not this week, but the following week. So in about 10 days or so. So let's start with the bonds and see what's going on. I'd like to look at the 2-year bond here. So it looks like what we saw is that the 5% here last week, this is on a daily chart of the 2-year yield, couldn't really breach the 5% overhead. And keep in mind that the Fed funds rate, as you guys know, is about 5.33%. So it's just going to be difficult mathematically to go through that, because if it were to go higher, that's essentially saying the market's saying that for the next 18 months, 2 years, that they don't expect the Fed to cut more than once, which is very, 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 very hawkish. And so at this point, the market seems pretty content just to say, okay, we got up to 5%. We tested there. And then it looks like, probably just going to range trade down to, let's say, maybe the 475, 4.75. So just in this 25 basis point kind of box here, we're going to be trading up and down. Now, why is that? I mean, what are the central banks, what are they trying to do? So basically, we can assume that both central banks, especially the Fed, they probably want the curve to steepen. Now, why is that? Because the issuance is huge. We have both of the candidates for the White House later in the year who seem very, very comfortable running very, very large deficits. I think it's about 6 trillion or something like that, both Biden and Trump. So the point is that the US Treasury will continue to need to issue huge amounts of bonds. And therefore, to entice real money, like leveraged buyers, pension funds, the big insurance companies, the big players, real money to buy and absorb all of this issuance. The central banks need to get out of this sort of negative carry, this sort of downward sloping inverted curve, and bring it up to a steeper curve. So the long end yields are higher than the front end yields, and just make it like a positive carry. Because at this point, if you're in these trades, you're essentially getting every day sort of a negative roll down. And all of this is basically going to require sort of a normal up sloping curve. So we have to imagine that that's kind of like the bigger question, I think, of what the Fed is trying to do, and probably also the ECB. And we noticed as well that last week we had relatively weak auction metrics. I mean, that was relatively the sort of the front end and the belly of the curve. This week, I do believe we have the 10 years. So the thing is that the auctions are starting to come under a little bit of pressure. And basically, that's the market signaling that, hey, we need higher yields, and we want higher yields, the bond vigilantes, maybe a bit more term premium. And that ultimately is what's going to be sort of pushing up the curve. And it's kind of interesting because I was listening over the weekend to Jim Bianco on a podcast from Bianco Research, and his point was that what could cause the bond market to really bring these deficits under control is that if the politicians really want the deficits, are very comfortable with these high deficits, Jim Bianco's theory, which is interesting, is that we could get sort of a so-called sort of Liz Truss kind of moment. And remember, Liz Truss was the UK Prime Minister, short-lived, I think about 2 years ago or so. And basically this idea is that the bond market will continue to absorb the issuance until it won't. The idea being that maybe if the politicians, continue to have these huge deficits, continue to issue enormous amounts of bonds, there could be a breaking point, and maybe that's going to be enforced by the bond market, which will just sort of say, okay, we want 5% yields, 6% yields, 7% yields, and that could be the breaking of the bond market, which might ultimately be the only way that some of these deficits will be forced to be reined in. But we'll see. But that's a bit of a political question. And again, the issue with that is that it could take 6 months or 6 years. But it's interesting theory, I think, this idea that the politicians will continue to spend money and go into very heavy deficits until and unless the bond market sort of steps in as the adult in the room to maybe sort of slap down the politicians by making the yields enormously high. Okay, so the other issue as well, let's say look at something like the 5-year yield here as well, is that the front end of the curve, let's say the 2-year and the SOFRs, they're really sort of trying to figure out what the Fed's doing. And the idea is that the Fed, a lot of commentators are saying the Fed should or needs to hike, but the reality is, especially in an election sort of year, the Fed, at least Jerome Powell has basically said, hey, we're not going to hike. Maybe we'll keep rates at this level for a longer period of time. But, the impetus for hiking is very, very remote, in my opinion. And so what that means is that the 2-year is going to be anchored around about that, maybe the top 5% down to 4.75%. But in the belly and longer end of the curve, those tenors are less focused on the FOMC, and they seem to be pricing in a sort of a higher a terminal rate, or at least maybe we could say a less aggressive cutting cycle. And we don't know when that's going to start. Is that going to start in 2 or 3 months? Or maybe some people are saying not until 2025. And there's been a lot of discussion, academic and theoretical discussion, about the neutral rate, the so-called sort of R star. And if it, as seems likely, maybe in this new sort of, post Ukraine war, post COVID kind of situation, we have structurally a different economy. Maybe it's likely that the terminal rate and R star needs to be a bit higher, maybe something between 375 basis points and 400 basis points. So not as historically as it's been low. And if we look, let's say something like the SOFR curve here, which I think I had up. Let me have a look. Yeah, so if we look at that here, I mean, I've talked to you guys about this the last couple of weeks, but it's kind of interesting. If you see here, this is all the 3-month bonds. Each point here represents a 3-month bond. So this goes all the way out, to 2030, 31, 32. So, 8, 9, 10 years out into the future. And it's interesting here, if we look at the terminal rate here, the market is saying, okay, we'll cut down to, maybe 3.8 or so. But the market is saying that the terminal rate, so further out, and this is, we can start extrapolating the yield on the 5-year, the 7-year, and the 10-year. Maybe it's not going to be at 2.5 or 2 or 3%. Maybe it's going to be more like 4.2%, as you guys can see here. And if we actually go back and look at where this chart was, or this curve was a few months ago, that was down sub 4%. So the point is that the market seems to be coming around slowly with a few ideas. The idea that R star, or the neutral rate, is going to be a little bit higher. And remember, that's the rate at which which is neither accommodative or sort of restrictive. And the idea is that you have the inflation rate, which the Fed continues to insist is going to be about 2 or 2.5% as their target. And then if we say that R star at the moment it's meant to be 50 basis points, the Fed's saying it's 2% plus 50 basis points. But if that might be more like 100 basis points or 150 basis points, we could have a neutral rate, which is somewhere maybe like, I don't know, 3.5, 3.75. And if we add on to that a lot of issuance, if we add on to that a slightly stickier kind of structural sort of inflation, maybe that basically means that, the terminal rate will be a little bit higher than it has been historically, and also that the cutting cycle may be more shallow, less deep than it has been historically. So a lot of people are saying, hey, in the past, every time the Fed has cut, it's gone down, it's cut, 250, 300, 350 basis points. Maybe we're in a regime where the Fed cuts, 4, 5, 6 times. Now, the rate at the moment of the Fed funds future is 5.33. If you take it down to, let's say, 4 or something, 5 or 4.10, which is kind of down here, that's basically only about 4 to 5 cuts. So a less steep cutting cycle, a less aggressive cutting cycle. So that's kind of interesting at that. So, and what that means is, therefore, getting back to the yields, if we just go back to, like the 5-year and yield and the 10-year yield, these kind of things, basically that means that they can't come down too much. So if we look at something like the 5-year yield, if we look, and we say that the terminal rate will be, maybe 4%, 4.10, 4.25% or something, you've got to say, can it actually come down too much more? That's my point. Maybe the market will say, hey, the front end can come down 100, 150 basis points. But if the belly of the curve and the long end of the curve, the terminal rate is not going to be that much lower than, let's say, 4.25, 4.5, we're already at those levels, and maybe it's not going to come down too much, and all of the work will be done by the front end. So what that means is that something like the 5-year yield you see here, maybe it's going to struggle to get below this kind of level here, 4.35, something like that. And if we look at the 10-year, which is here, maybe it's going to be difficult to get below, something like here, 4.33. So the point is that I think that, the 5-year, the 10-year, and the 30-year, if we look at the 30-year as well, probably can't come down too much more if we assume that the neutral rate is going to be higher than than it has been for the last 10 years, if we assume we're in a slightly stickier inflation environment, and if we assume that the economy, goes along relatively strongly. Now, of course, all bets are off if there's some crazy geopolitical event, or if the American economy, really does, start to kind of collapse and there's like a pretty heavy recession. Excuse me. Anyway, so that's all kind of interesting. And so the other thing as well is that, so at this point, maybe the front end is kind of anchored because we're waiting for the Fed when and if they're going to start cutting. And then the medium, the belly, and then the long end of the curve is maybe not going to move down that much either. Just because if the terminal rate's going to be, relatively high. And so what that's arguing for is some, relatively low volatility situation in the bonds. And if we go over the MOVE index, which is the sort of like the VIX of the bonds, we can see that, it's been trending down as in basically in a low regime. I mean, occasionally 2 or 3 days here and there it goes up, but it's been sub 100 for, basically, what's this, like, 15 months or so. And who knows, maybe this will just drift down towards, 80 or something like that. And that indicates that the bond market doesn't believe there's too much going to be happening just at the moment. So what that would seem to be saying is that it's signaling kind of range trading. So we have a fairly low vol kind of environment. But of course, what we're trying to do is actually to to make some money. So I guess the point here is that you have to start looking at something like your Bollinger Bands. Let's just go back again to the 2-year yield. And what I'm trying to, when I say Bollinger Bands, you have to start looking at your overextension. So when are your RSIs overbought or oversold? When you're at the uppermost and the bottommost limits of your Bollinger Bands, your average true ranges, what you're looking for here for trading, and this is what I'll be looking for this week and over the next, leading up into the Fed, is just, very precise, small little trades. This is not the moment for long-term structural kind of calls, unless something, significant happens. You're just technical trades trying to sort of sell at the top end of ranges and sort of buy at the bottom end of ranges. And that's it, so that's all we can do. Right. Okay. So that's about it just in terms of that there. So let's just look at a couple of other specific sort of charts here, guys. I just want to look at the curve here. So let's look at the classic, let's say the US 2s to 10s here. And again, it seems to me that in this regime, if the Fed, when and if the Fed does start to cut, presumably that's going to be more on the front end. So those yields will go down, which will steepen the curve. And on the other hand, if we assume, as I've just been saying, that maybe the neutral rate, maybe sticky inflation, maybe the economy is relatively strong, and of course the issuance, that would be bad for the long end of the yields going up. So it looks to me like the steepener is probably where things should be going, and we have seen a couple of days of that. But the point is here that could probably move up a little bit higher, maybe even up to something like about the 25 basis points level, and then maybe even all the way up to minus 15 basis points. I think it's going to go there, and eventually it's going to break out of this range, which is about minus 15 basis points. So it could pull back on an intraday kind of or on a daily basis, but I think the direction of travel is going to be here. So looking to maybe for some kind of pullback Certainly if it gets back down to this 50, what's that, 47 basis points, that would be a fantastic buying opportunity, or 50 basis points, we shall have to see. Okay, now the other thing as well, what the ECB on Thursday, as you guys know, they are expected to cut. Let's just see the pricing. It's basically fully priced in at this point. So let's just have a look at that. And as you can see here, oh no, I just want to pull that up there. Yeah. So the ECB, I've got it here. You can see, 24 basis points. So a full cut is fully priced in. What's going to be interesting is going to be the way that Lagarde signals that. But to be honest, what really the market's expecting at this point is a fairly hawkish, data-dependent cut. So it's probably going to be a cut, but extremely kind of hawkish. And I would say that Lagarde will emphasize the fact that they're data-dependent. And that they're not on any kind of predetermined cutting cycle. Anything more dovish than that, I think, would be a bit of a surprise. And as you can see, what the market is basically saying is that the next full cut, which would be 50 basis points, not really being priced in until the end of the year, anywhere between the mid-October and mid-December meetings, 44 to 54 basis points. So somewhere, in the late autumn sort of slash early winter. So that'll be interesting to look at. And just while we're here, let's just look at the Euribor kind of curve. Again, similar kind of situation there, that if we just see what's the rate now, 3.91 is the effective rate for the Europeans, for the European Central Bank. And again, if you look at the where we are today, it's this kind of orange line. This is the implied yield. And again, you can see that the terminal rate is not that much lower. I mean, it's, what do we say, 3.9, so it's about 2.7, so it's about 125 basis points lower, so about 5 cuts or so. Not an especially deep cutting cycle. And also what I want you guys to note here is, if we go back, let's say a month or so, which is the green line, you can see that that terminal rate has been revised upwards since then, or has gone up since then. So both the ECB and the Fed, really this idea that yeah, maybe they're going to cut, once, twice, 3 or 4 times over the next 6, 9, 12 months. We're waiting for those details. But the bigger picture, I think, is that structurally we're in a different regime. And a lot of people just started trading, the last 5 or 10 years. People haven't really sort of in this mindset from the post-financial crisis, from, let's say, 2008-9 up until, let's say, COVID, where there were very, very low interest rates, negative interest rates in Europe, very zero interest rates, terminal rates at 2.5%, the 10, 30 year at 1%, 1.5, 2%. Those days, I think, historically are over, at least for the immediate future, unless we have a crazy recession or a geopolitical risk. And therefore, the markets are just slowly absorbing that hey, maybe like the 10-year yield and the terminal rate, as I say, is going to be for a long time mid-4s, mid-5s. And that's not necessarily a bad thing, because if you go back historically to like the 80s, 90s, and the 2000s, if the economy is doing pretty well and inflation's 2.5 or 3%, it's normal that the real yield might be 150 or 200 basis points above the rate of inflation. So we get like a nominal yield of 4% or 4.5%. It's not necessarily a catastrophic disaster. So that's kind of interesting. Okay, but let's just have a look at some of the, as I say, the yields or some of the charts over in Europe. So let's go to, let's say, the Schatz, which is the German 2-year, which I have here. And again, what's kind of interesting here, guys, is that you see on the daily chart here, the yield, as we're going into a central bank meeting, the ECB, on Thursday, that the yields have actually been pumping up. They've gone up, 10, 20, 30 basis points here over the last 10 days, which is quite unusual historically to see the yields being pushed up as we're going into a cutting cycle. And again, that's just speaking to the fact that that the market believes that the ECB, is probably, not going to start an aggressive cutting cycle. And as I've been saying all throughout this video, that the cutting cycle will be relatively shallow, potentially, compared to historically. So that's where we're at. But again, probably this is, again, going to be some kind of upper limit here, about 3.1, 3.15, looks like sort of the uppermost limits. And again, you'll notice how it's difficult to push further north than the Bollinger Bands. And again, down here, the range down here on the bottom of the Bollinger Bands. So at the moment, as I say, this idea of kind of range trading. And again, will the market get lower than, let's say, 2.55? Oh, sorry. Let's just go on the 5-year here. Again, see this Bollinger Bands. This is on the 5-year here. And again, this idea that, okay, that's maybe like the toppermost limit, 2.7 or something. But then what I'm trying to say is that down here towards the bottom of the Bollinger Bands, can the market go too much further south? Maybe, probably not. I don't think any more than 2.44, or maybe even like the 2.55, just because the idea is that, hey, even if the ECB cuts, we kind of know that it's not going to be especially deep, the cutting cycle. And as I've been saying, the structural inflation might stick around a little bit more. We have, less efficient supply chains, and that maybe, in terms of the terminal rate, the 5 and the 10 don't need to come down, or can't come down too much more. So that's kind of interesting as well. And again, if you look at, let's say, the German 10-year, similar kind of situation here, that, it's kind of stuck up here and probably can't come down too much. So again, range trading, again, just be looking at those Bollinger Bands. What is kind of interesting, again, just to look at the yield curve here, I'm just going to put on the German, let's see, do I have the German, the 2s to the 10s? Again, this is kind of an interesting one here. It's been steepening, and again, I expect that that's probably going to be, that's probably going to steepen a little bit more. Maybe any sort of soft data, any more dovish commentary that could bull steepen. And again, if we get slightly stickier inflation or economic growth, maybe sort of more of a bear steepening here. So we see that it's been more or less in a range, but it could sort of break out up to the minus 32 basis points or so. That's definitely something to be interesting in, or maybe even up to minus 25 basis points. So keep in mind that the steepening should happen over in Europe as well as the US kind of space. One thing which is kind of an interesting chart, though, is the French 10-year, which is the OAT, which is kind of a technical market. I wonder if I have it here somewhere. Sorry, guys, I've got way too many things here. I thought I had it with the Italian bonds. Oh, there we go. So let's have a look at the French one. And it's quite interesting. Just this is something I'll be looking at. You see this level here, which is about the 3.25 level, 3.24, quite a strong overhead resistance. And it's been, the yield's been pushing up more and more, since essentially, all of this year. That could be quite an interesting level there to get long the OATs, the 10-year OATs, maybe as a spread, versus the US or something like that. Just because, it's going to be difficult to go too much higher, if the ECB is cutting. And again, it has come a long way. There's still a bit more to go. Let's have a look. I mean, just where we are today, you still got another, let's say, 10 basis points or so. But just from a risk reward perspective, that could be quite an attractive entry point, as I say, about 3.24, 3.25 on the French 10-year yield. So that's kind of an interesting one. The other thing as well, I just want to draw your attention to, guys, is just the differentials here. So if we look at the, let's have a look if I can find those. So I want to find, okay, so let's look at the differentials here. So this is the US 2-year yield subtracting the German 2-year yield. And what you can see here is that they've closed. They've got a lot tighter. So coming down from, over 2% now as we speak, about 1.79% in favor, kind of favoring the Europeans. And we get it, just, tightening up a little bit. But that's a little bit strange. I mean, just because the ECB, at the end of the day, is going to start cutting this week compared to the Fed, and then but then they've come down quite a lot, as I say, about 20 basis points or so. So what could be kind of interesting there is that let's say this 1.7% level, if the 2-year the differentials on the 2-year gets down to this 1.7 percent level, which is about another 9 basis points, that would represent a really interesting kind of risk reward in terms of going long the Schatz, so the German 2-year versus short the US 2-year, based on the idea that, hey, at the end of the day, the ECB is going first in cutting, and potentially could cut a little more than the Fed, just because the economic situation and the issuance is a bit different. So that's definitely something quite interesting. And again, if we look at something like the Schatz, versus the ZF or the 5-year here. This is the 5-year differential. Similar kind of thing. You see that this has come in a lot, pretty aggressively over the last 5 or 6 weeks or so. And something like 1.74, 1.75. I've got the blue buy box here, would be interesting. And just similarly, if you look at the on the 10-year, similar kind of situation here. If that comes down to 1.72, 1.73, maybe this level down here, that would be pretty attractive as well. And that could go all the way back up to, let's say you got on here, that could go back up maybe up to here or so. So some quite interesting trades coming in for the differentials. But again, we need a more attractive entry point. We'll see what Lagarde has to say on Thursday, and of course how the data and general situation happens in the US. I'm not going to talk too much about the dollar index. I think that's sort of trading in a range. I might talk about that a bit more going through the week. What I will talk about though, guys, is let's look at commodities. So let's just look at start off generally with something like the DBC, which is kind of a pretty broad-based kind of commodity basket here. It's been trading more or less in a range. You see this kind of range here from about $23 up to about $24 here. One thing I would say in terms of, people sort of really freaking out about super high inflation and inflation reaccelerating, if the commodities remain relatively range bound, it's difficult to see inflation accelerating dramatically. Okay, inflation can be sticky. It can, drift up a little bit, but in terms of a radical acceleration, that would need to involve a broad basket of commodities reaccelerating in price a lot. Now, is that possible? Of course, anything's happening, but just at the moment, keep in mind that if we look at something like DBC, just a range trading, and you can see that very clearly if you look at, let's say, quickly just look at the weekly chart. You see, the weekly, the last, 6 or 8 weeks, just basically in a big box there. We'll go back to the dailies. What would be interesting, it would have to probably breach, up towards this late 23s, $24. It would have to break out of this box to give us any kind of signal that it wanted to go higher. So at the moment, just trading in a box, which of course has implications for the yields, because if we assume that inflation cannot massively reprice towards the upside, that also means that the top side for bond yields on the 10 and the 30-year yield, for example, okay, it could drift upwards a little bit, but is it really going to explode much higher than where it is at the moment? Not really. And again, that gets back to the earlier point that we're probably going to be in some kind of range. What is kind of interesting, though, is oil. Now, we all know that we had the OPEC meeting today. Quite complex, and some people saying it was a little bit on the bearish side, other people saying a bit more bullish. Essentially, let's just quickly review. And let's look at the market. It's come down at the open here. You see that it had been range trading. Now, the question is, so basically of the 8 producers, so let's just review the 8 producers who had the voluntary cuts. And they're going to continue in the 3rd quarter. But from the 4th quarter, so kind of from October, they're going to be gradually phased out. Okay, so those voluntary cuts are going to be gradually phased out. Now, some commentators had been thinking that those voluntary cuts may have been extended until the end of the year. So technically, they're going to be phased out over the following 12 months from the 4th quarter. So that could be a little bit negative, because that could let's say by 2025, January, February 2025, we could start to see another 750,000 barrels of oil on the market. So that could be a little bit bearish. On the other hand, does that indicate a certain amount of confidence amongst the OPEC Plus members that the market is relatively strong and they could afford to just loosen the spigots a little bit? Possibly. Let's just look at the reaction here. If we put it on, let's say, a 3-minute chart. So just again, Sunday, you can see that the market gap down, 20 or 30 ticks, couldn't refill the gap, and now it's just drifting down. So the market is taking that a little bit negatively. Again, not a huge reaction. We'll have to see where a bit more liquidity comes in tomorrow. But for sure, this is going to be a very key test down here, 75.50 on the CL1 contract. And again, remember, Brent is slightly different. So overall, the production cap has been maintained by OPEC Plus at about 39 million barrels. But and the sort of the structural cuts, or that structural cap, had, was scheduled to end at the end of June here, but that's now been extended to the end of 2025. So the point is that, okay, maybe they're going to produce a little bit more. The voluntary, in terms of the voluntary cuts might end, but the reality is that the structural production cap, in theory, although Russia and Iraq seem to be cheating, has been extended out until the end of 2025. So one could argue that, structurally, there is still a bit of oil being taken off the market. On the other hand, the big winner probably from this meeting was the UAE, United Arab Emirates, and they've been given the green light essentially to produce an extra 300,000 barrels per day as their 2025 production target. So I would say overall, net fractionally negative for the market, but the fact that OPEC Plus thought that they could slowly reduce those voluntary cuts indicates to me that they think that the market is relatively well balanced. It looks like demand from China is, relatively robust. The US economy seems okay, and the Europe seems okay. So there's no sign that the global economy is failing or falling particularly, or certainly it's not collapsing. So I think at this point, the market's going to be pretty technical. I'm going to start to be drawing, it's the moment to bring out the fibs and the technicals. And as you see, if we can look here, this is going to be an absolutely crucial level here. And it would not surprise me if the market tests that, because this level, as I said here, that's a horizontal support. It's also probably going to be, maybe lower end of the Bollingers, but more importantly, it's got a 68% fib from this big level here, going back all the way to December 23 and down here. So I think I'm going to let it drift down there. That's going to be an extremely interesting level there. I think buyers quite possibly will come in there. So let's keep an eye on the time spreads and just see how the market is taking that. In fact, that's kind of an interesting one to check out here. Again, put on the 3-minute mark, just looking at I'm going to look at December 24, December 25. Similar structure here to the outright price on the prompt contract, sort of gapping down. This one did close the gap, but sort of drifting down a little bit. So definitely tomorrow morning, I'll be looking at that just to see how the market's taking that. Also, what we get tonight is the selling price, the official selling price, the OSPs. We'll see if the Saudis into the Asian market especially feel confident to keep those prices up. So that's kind of an interesting one to look at. The other thing as well, guys, briefly, just getting a little bit long here, is that the precious metals did come off a little bit, and I'm just going to put it up onto gold, put it on the spot price here. You can see we're at some pretty key levels here. This level here of about, a 23.20 is a pretty key level here. It's also, we're starting to get some sort of some fib supports broken down through that shorter term fib support. If you want to bring it down there, it's about the 38%, or if you want to go all the way down here, you could still go down there. So the point is that some of the fibs are being broken. I think this is, it's pretty simple here. If you want to have a shot at this, you can, that's a good level. I think I'd prefer down here to 22.70 or so, just let it drift down a little bit, just because gold has been coming down, but silver did have a fall, but again, at a very attractive fib level. It's, the risk reward for those of you who want to dip in is not bad. You see this this fib here from here, it's at the 38% level, just here on the futures, about $30.3. Quite interesting, but copper also coming down to sort of interesting fib levels. So all of the metals are both sort of precious and industrial. I might talk about that a little bit later. At interesting technical levels here. Let's have a look. I think it's worth a shot, just in terms of sort of trading from technical levels, and your risk reward is pretty much well established here. Just finally here, guys, let's have a look at the equities. We had a bit of a crazy close on Friday. They were strongly bought. A lot of, it was the end of the month. Who knows if there maybe sort of month-end flows here. But again, what I would say is that there are a couple of key levels here on the SPX, on the cash. 52.54 is a a pretty key level here. We've got that sort of horizontal level there. If it closes above that, can it push higher? For sure. But at the end of the day, relatively low vol. It looks to me like a buy on dip situation, but maybe it doesn't want to test too much higher. So I think it's going to be capped by fib extensions, or let's say the Bollinger Bands. You can see here it's got a bit more to go up on the upside here. But overall, we're in a kind of a sideways market. With equities, probably preferred to bonds, all things considered. So why would you be buying, let's say, selling equities compared to bonds? Equities are a bit of an inflation hedge. The economy seems relatively strong. There's been a lot of buybacks. I mean, you think about the question of issuance in a broad sense. The US Treasury is issuing an enormous amount of bonds, whereas the number of buybacks by US companies is very, very strong. So there's actually less stocks for sale in a certain sense and more bonds for sale. So just on a comparative kind of level, I think stocks are a little bit, pretty attractive in that sense. But we'll have to see what the FOMC is up to. They're probably going to say that they're waiting, they're data dependent, but they do have a bias to cut. So I think in that kind of environment, it's going to be difficult with a Fed which is waiting to cut for equities to absolutely collapse. So I think at this point, what you want to be doing is buying sort of Fibonacci retracements, strong horizontal levels. I mean, can this sort of on the SPX, can it go up a little bit more? There's a little bit of a gap here, maybe up to, I don't know, 53.05. You see there's a little bit of a gap there. If we look at, let's say, the Nasdaq or the cash index NDX, you can see that 18,200, which is this level here, that was bought on Friday afternoon. That's obviously a bit of a key level there. Can that push up? Yes, it can. I mean, and if we put it on the weeklies, you just give a bit of a context, because at the end of the week, end of the month, you can see that Nasdaq or the NDX, it touched its Bollinger Bands on the weekly. So maybe that was one of the reasons that was under a little bit of pressure. That's kind of interesting. So it looks like, that 18,800, 18,900, just for the moment, is the short-term resistance. But on the other hand, if we want, some kind of targets, if you go on the monthlies, you can see that, to be honest, like the Bollinger Bands on the monthlies for Nasdaq are up at, I've marked it at about 19,500 or so. Why not? Could go up there. And what you'll see is that on the NDX, there's a little bit more room on the monthly Bollinger Bands compared to the SPX, which is also, you already see on the monthly Bollinger Bands that actually came down a little bit. So who knows? Maybe there's going to be a bit of outperformance of the tech names against the broader index this week. And some of that will be a little bit dependent on the data. Just finally, guys, just want to see, things, some of the other global equity markets. Got the European equities here. We can see that on the Euro stocks is doing relatively well, maybe some kind of flagging formation here. But I'd say that something like the 4,900 level, this kind of level here is not a bad level to be buying. Maybe 4,860 up to about 4,900. Anything down there, I think, is going to be supported and be quite a good level. The same with the Japanese stocks, like the Nikkei. I mean, for sure, something, down around 36,000 would be a great level if it does get down here. I mean, keep your eye on that, maybe put some kind of alert. That would be pretty good. 35,000, 35,500, 36,000 would be fantastic levels to be buying those global stocks there. Also, emerging markets, which I do have here somewhere. I do have emerging markets here somewhere. Where's my EEM? Oh, here we go. Emerging markets here. Let's say something like 39.90. If we ever got down there, that would be kind of an interesting level as well if it gets down there. So on the global equities, so sort of Europe and Japan for the developed markets, maybe even the emerging markets. I just think in this environment where we have a pretty strong global economy. We don't have overly aggressive central banks. We have one or two central banks maybe even starting to cut, even if it's shallow. And we have like terminal rates and real yields remaining relatively strong. It looks to me like an environment where bonds are going to be, where stocks are going to be bought on dips, at least in preference to bonds. So that's something to be looking out for. Okay, guys, it's gone a little bit long, so I'll leave it there. I quite possibly will start doing the daily, the quick morning previews, and as well as some data and sort of event previews as well. this week to keep you up to date. So hopefully that'll be useful as well. Anyway, again, apologies, it was a bit long, but hopefully that was useful. We'll talk soon. Thank you and have a good evening.